If investing were just about being smart, chess grandmasters would dominate the hedge fund league tables. But they don't. Because markets don't reward intellectual horsepower alone, they reward rationality. And that's an altogether different beast. The great investors we admire, Buffett, Munger, Marx, Klarman, Dalio, not only build robust valuation frameworks, they also build robust mental habits. They don't just refine their models, they refine themselves. This video, part of the 10 Things Great Investors Do series, explores how elite investors develop what psychologist Keith Stanovich calls a high rationality quotient, RQ. They know they're biased, and rather than pretend otherwise, they design processes, cultures, and tools to manage those biases. In doing so, they tilt the odds just slightly, yet consistently, in their favor. Most analysts can spot a discounted cash flow error or sniff out a flawed comp table. Fewer can spot the cognitive trap they're falling into while doing so. Stanovich distinguishes between IQ, intelligence quotient, and RQ, rationality quotient. And the overlap, he warns, is smaller than most people assume. Warren Buffett captures the distinction with a metaphor. I always look at IQ and talent as representing the horsepower of the motor, but the output, the efficiency with which that motor works, depends on rationality. A brilliant analyst with low RQ may still make impulsive decisions, overreact to market noise, or double down on a thesis to protect their ego. The takeaway? It's not how fast your mind runs. It's how straight you steer. The Nobel-winning work of Kahneman and Tversky in behavioral economics formalized what traders had long sensed. Human decision-making is riddled with systematic errors. Availability bias, giving too much weight to easily recalled information, like the latest earnings miss or headline. Representativeness bias, overweighting superficial similarities. This company looks just like Tesla. Anchoring, latching onto a reference point, even if it's irrelevant, like an all-price target. Then there's prospect theory, which shows how investors fear losses more than they enjoy equivalent gains, a phenomenon called loss aversion. It might make sense evolutionarily, but in markets, it leads to irrational selling on drawdowns or refusing to cut losing positions. Time and again, we've witnessed scenarios in the markets where bias has broken portfolios. We've pulled out 3 examples for you. First up, Bill Hwang's Archegos capital management imploded in 2021, wiping out over $20 billion in a matter of days. Armed with leverage and conviction, Hwang built huge synthetic positions in a small number of stocks. What began as a strong thesis became a blind spot. Confirmation bias led him to discount contrary signals. Overconfidence drowned out risk controls. The lesson? Intelligence and access aren't enough. Without self-skepticism, conviction becomes a liability. Ackman shorted Herbalife, calling it a pyramid scheme and vowing to take it to zero. His billion-dollar bet lasted 5 years, becoming a media spectacle. But even as the thesis faltered, he held on, perhaps unable to detach from public commitment. The longer the battle raged, the harder it became to walk away. Ultimately, the position was closed at a loss. Commitment bias can be as expensive as it is public. In early 2021, retail investors on Reddit's WallStreetBets sent GameStop shares soaring. While the movement had elements of financial activism, much of the behavior reflected availability bias. GME is trending. Social proof, everyone is buying it. And loss aversion, hold the line. Groupthink overrode individual judgment. The result? Wild price swings untethered from fundamentals. At the core of high RQ is epistemic rationality, the ability to hold beliefs that accurately reflect the world. Investors with high epistemic rationality are well calibrated. They don't just make bold calls, they assign realistic probabilities and update them when new evidence emerges. Philip Tetlock, in his super forecasting project, found that the best forecasters weren't necessarily the smartest. They were those who revised their beliefs frequently, sought disconfirming evidence, and tracked their accuracy over time. For investors, this means grading past calls, logging predictions, and asking, was I right for the right reason? Great investors don't pretend they're immune to bias. They anticipate it and implement deliberate strategies to bring it into the open. One such technique is the pre-mortem, a simple but powerful exercise where the investor imagines it's a year into the future and the investment has failed. The question is then posed, what went wrong? This forward-looking hindsight forces a confrontation with potential weak spots in the thesis that might otherwise be ignored. Another tool is the decision journal, where the rationale behind each investment is clearly documented at the time of the decision. This written record becomes a powerful feedback loop when reviewed later, clarifying whether outcomes matched expectations, and if not, whether the original reasoning was sound or flawed. Red teaming offers a social dimension to bias mitigation. By inviting colleagues, especially skeptics, to actively challenge assumptions, the investor exposes blind spots that would remain hidden in a more consensus-driven environment. The point isn't to reach agreement, but to test conviction under pressure. Then there's reference class forecasting, a technique that deliberately resists the urge to treat every situation as unique. Instead, it asks what has happened in similar cases in the past. By grounding forecasts in empirical base rates, investors avoid the seduction of overconfidence and narrative-driven optimism. None of these tools guarantee rationality, but that's not the point. They don't eliminate bias. They make it visible, so it can be named, examined, and managed before capital is at risk. Individual discipline is important, but environment shapes cognition. Great investment firms foster cultures where dissent is safe, egos are checked, and decisions are process-driven. Bridgewater Associates, for all its idiosyncrasies, has institutionalized this with its idea meritocracy. Radical transparency and open debate expose flawed reasoning early. While it's not for everyone, it underscores a point. Better decisions come from better design. Rationality isn't a genetic gift, it's a trained habit. Platforms like clearerthinking.org and Farnham Street offer tools to improve mental models. Reading Kahneman and Tetlock is useful, but practicing slow thinking, listing opposing views, and using checklists can deliver tangible returns. Even something as simple as deliberately slowing down high-stakes decisions, asking, "What would change my mind?" can elevate our IQ. There's a valid counterpoint. Sometimes gut feel is built from years of pattern recognition. It's not irrational, it's fast, compressed intuition. That said, gut instinct should be viewed as a hypothesis, not a conclusion. Great investors combine it with second-level thinking and rigorous testing. Markets are messy, humans are messier, and perfection is a myth. But great investors don't aim to be perfect. They aim to be less wrong. By acknowledging their own biases and building systems, cultures, and habits to mitigate them, they compound not just capital, but judgment. The rational investor isn't a Vulcan. They're just someone who knows that the mind is a noisy place and invests accordingly.